morning, welcome to news. It's Thursday, 17th of September. Interesting news today, we're predicting no recovery until 2023. Last night, the US Fed confirmed it was keeping near zero interest rates until 2023 and would continue with at least the current indefinite $120 billion per month QE program, 80 billion US Treasuries and 40 billion mortgage-backed securities. So, to be clear, things are so bad that they need to stimulate for 3 more years. And yet shares in companies generating earnings in such an environment went up. Again, the key message was that the central banks can't do all the heavy lifting, and any recovery needs to be led by government spending. The news was no better for Australia. Our own RBA was bemoaning our high AUD, stating it needed to drop to really allow us to recover, and yet they continue to do nothing more themselves to facilitate that actually happening. Instead, the calls for government's fiscal spending continue. There have been a number of reports arise just in the last few days that outline the central bank and the government's dilemma. On the job seeker front, the COVID supplement is due to be reduced from $5.50 per fortnight to $2.50 next week and abolished altogether by the end of this year. Deloitte Access Economics concluded that doing so would cost 145,000 jobs in just 2 years and reduced GDP growth by $31.3 billion. We then have the mortgage repayment holiday and the impending cliff when it is removed, timed to coincide with the aforementioned job seeker as well as the job keeper reductions and the end of the early access to super. Over the coming weeks, around 450,000 mortgage holders and 100,000 small businesses with loans will be contacted by the banks to give them the bad news that the holiday just means more payments need to be made up and the extra interest accrued on top of that. It was a holiday, not a pardon. The impacts on consumer spending, impacting GDP and forced sales, driving lower property prices could be enormous. ANZ Economics released a report stating that even assuming an extra $180 billion in fiscal spending over the next 4 years, they don't see our labour market recovering until 2023. Check out this next chart here, showing employment and how it won't really return to its pre-pandemic level until that 2023 period. Also comparing it to the 80s, 90s recession and the GFC. We are by far exceeding the recessions shown in those previous periods. In terms of GDP, they don't see a recovery until the second half of 2022. The following chart that we're going to show you paints a clear picture of how deep this hole is that we need to negotiate our way out of. Again, COVID by far exceeding what happened in GFC, 1990s and 1980s recessions. This is big. The last night the OECD reinforced this position also highlighted the dilemma before ScoMo right now and the pressure to extend all these support measures versus the long-term fiscal impact in doing so. The OECD have assessed that the second wave and lockdown measures employed by Victoria just pushed out our timing to recovery. Like ANZ, they are saying it will be 2022 before we recover. Whilst they upgraded our 2020 forecast from -5% to -4.1%, they slashed the 2021 recovery by nearly 40% to just 2.5%. Off that low base and hence no recovery until 2022. Only France and Italy had bigger downgrades. However, while joining at the chorus for fiscal spending on public infrastructure, they warned against the continuation of support measures such as JobKeeper and loan support, essentially calling for a ripping off of the Band-Aid and letting the businesses fail. They warned failure could hinder aggregate productivity and the economic recovery by trapping resources in non-productive or zombie firms and jobs, and reduce the prospects for job switching to more productive and higher paid positions. Young people are particularly exposed to these risks. The Grattan Institute believe it could take almost an entire decade for us to recover lost output without the 100 to 120 billion of new government economic stimulus. It's inevitable that we'll have large output gap this year. The second largest state in the country has been in some form of lockdown for most of the financial year so far. But the really scary part is that the output gap is expected to persist for more than half a decade. On the PBO or Parliamentary Budget Office's projection, we won't close the gap between actual and potential output until 2027 to 28. In total, the output gap over the period between now and mid-2027 is projected to be around $620 billion in inflation-adjusted terms. This projection should shock. If it comes to pass, room for for the better part of a decade with the economy operating well below potential, with unemployment higher than it could be and living standards below where they could be. This next chart here from Grattan Institute showing the output gap that we just talked about. How we'll get back to even around 2028. It's a bit of a wait for everybody there. What is clear that is not an easily negotiated or quick exit from the worst recession in a generation. Talk of V-shaped recoveries are over-optimistic. Central banks will continue to ease for years to come, enticing speculation into a fundamentally weak market. Governments will employ deficit-funded stimulus, but more likely into infrastructure than helicopter money, meaning more short-term pain at the consumer level before it translates to jobs, albeit in targeted areas and industries. It is hard to see share prices at current valuations or house prices rising amid such fundamentals. But fundamentals will be offset by stimulus, and things could get more bubble-like before this debt-inflated bubble eventually pops or has a drawn-out deflation. By all means, have a punt, but ensure you have a safe haven hedge in place or invest in assets that can't recklessly be debased. And that's our news for today. Thanks for joining. Of course, you can jump over to ainsleyBullion.com.au to read any of our other news and to purchase gold and silver. Check out Ainsley Wealth for any of our cryptocurrency projects and products. And if you haven't yet done it, check out goldsilverstandard.com. That's our gold and silver backed cryptocurrency. The ease and efficiency of purchase and buyback that you would expect from any cryptocurrency. Have a great day and we'll catch you tomorrow.